You released your numbers, and I must say they look fairly resilient. The general insurance business seems to be still struggling. How is that panning out, and what's the way forward?
Okay, the general insurance business as a whole has been struggling given the general environment. If you look at our book, half of it is motor. And because we're in the middle of a pandemic, a lot of our customers switched to third-party insurance, because cash flow was tight. And then, of course, we had some historical issues. So in the larger scheme of things, when the economy goes through some pain, general insurance is the first to suffer. And this was no different from us here in Jubilee. So when capital is tight, somebody will say, do I take home insurance or do I put food on the table? Do I pay for comprehensive insurance or do I pay school fees? So it is usually the first one that gets a hit. And so if you look at even across the industry, motor did very badly, and which is a very significant part of general insurance. Luckily for us, we had split the general insurance and health business. And the health business stood, and it's doing very well in spite of the pandemic. So if you look at it on balance, when you combine the two, overall it did well. But the general insurance, what is normally called property and casualty, didn't do very well in those because of those circumstances of motor, home insurance, and many of the other risks.
Still looking at your numbers, I saw something to the tune of 108 million shillings in finance costs. Could you just explain that to us?
Okay, we took a loan to pay for Bujagali. We increased our stake in Bujagali in Uganda, and that contributed to that finance cost. Yeah, but it was also leveraging dollar loans and shilling loans, and which one was more efficient. So, and we thought that was the most efficient way of financing the project. So we have increased our stake now in Bujagali, and we think it's a very good long-term investment for our DA funds.
Your numbers in the health insurance business look relatively impressive vis-a-vis other lines, and one key concern that I get in the pandemic environment with insurers is cash flow management in a pandemic scenario, because of course the claims, as you'd imagine, are coming under pressure here. Yeah. How are you managing that?
Okay, I must say the health business went through a very deep restructuring in 2017, and which was, first of all, to deal with governance issues and technology issues. So a lot of things have gone on in our health business that then gave it a very strong foundation. So a lot of customer issues had to be streamlined, a lot of systems issues were streamlined, and then governance structures. That was completed in 2017. So that puts the company in a very good position even when this pandemic happened. Because if you look at our health business, 95% of our staff work from home. Yet customer service issues have dramatically improved. So we have very good customer service even when employees are working from home. The other thing we have done for our health business, it has gone 100% paperless. So all our service providers, hospitals, send in their invoices through e-claims. So there's no paper involved. And then it's processed very fast. So the turnaround times for our customer service has improved dramatically. So all that combined then has given us a very strong position for a very good customer offering. Because then when they go to our partners are happy, the hospitals, because they have been paid. Okay? Our customers then are served well, and then the risk of fraud is minimized because the whole process is now fully electronic. So we have dramatically dropped frauds. There's very little human intervention, and then also our refund to the providers has been very quick. Yeah, actually we pay our providers twice a week So we probably are the most efficient in the industry. So as a result, our growth in the health business was 10% over the year, and that was very good in a very difficult year.
Speaking about your partners being happy, one of the key challenges facing the insurance industry in Kenya is asset liability mismatch. And when you talk about partners not being paid, that's something you hear quite a lot in the industry. What's your assessment of the state of the industry?
The industry is suffering from a capacity issue. Many companies cannot pay very good actuaries, because that is where the problem begins. When a risk is not priced well, it has ramifications over the years when the claims start coming in. So one of the things that we have done in Jubilee is we have invested heavily in risk managers. Our actuarial systems are very strong. Our external actuaries, which is required by law, are also very good. So the advice they give to our underwriting teams is very, very strong. And in Jubilee, we don't accept accounts which are loss-making. We have said no, because that loss eventually will be paid by somebody, and typically it ends up with the shareholders. So we don't want to penalize our shareholders a few months or years down the road because of poor actuarial services or underwriting. So that is what we have really emphasized, and it is paying off for us, because then when other players are pricing incorrectly, us, we are very strong at that, and that shows the resilience of our results. A lot of it is just very strong risk management right at the start, and all the way to even managing fraud at the claims level. So those mismatches that occur with assets and liabilities is just because of poor business practices.
A number of stakeholders in the insurance sector will tell you that one major challenge they face is price undercutting in the industry. And some have gone as far as proposing that perhaps there is need for some form of regulation as to how the pricing should be conducted, pretty much the same way the CBK gives banks guidance on risk pricing models. Would this fly for you?
Amboko, let us not burden the regulator with things like those. You see, when you have bad business practices internally, you can't go to the regulator. The regulator will tell you, those are pricing decisions is an internal decision in a company. So I know our regulator has tried. Actually, there's a circular issued in 2019, February, which is setting minimum prices. But how many companies violate? Okay? So my own recommendation is that we just have to accept as an industry to have sound business practices. Train our employees to make good business decisions. By the time a regulator is setting minimum prices, you're actually reaching a point where you should be asking yourself, should we be in this business? Okay? So those underpricing, underquoting is because companies have reached desperation level. Cash flow is now very tight, so you are valuing a shilling today, but postpone the problem to tomorrow. But because of capital adequacy ratios, it catches up with you. So that is why the regulator has proposed we go into risk-based approach in calculating the capital adequacy, so that then whatever business you are taking on should be matched with your capital. The risk, the higher the risk, the higher the capital. So that is what the regulator is proposing, depending now on your risk appetite. But the key thing is the industry just must be disciplined and adopt sound business practices.
But Dr. You and I appreciate that self-regulation in industries can be a bit tricky sometimes. And why this undercutting is a big problem is this. So I undercut in a manner that makes my underwriting not profitable. Eventually, the capital structures come under distress. If this happens at a systemic level, even solid players now come under threat. Don't you think then that would necessitate some intervention here?
Okay. You see, I've been a regulator before for wildlife. And my principle has always been, okay, market intervention should only be in areas where there are obvious market failures. Okay? Now, the insurance industry has 51 players, almost. Now, these players, it's a very robust market. So, therefore, regulation then should be very light and allow the players to do their thing. Unfortunately, we are in a situation where a lot of the players are too small. So one of the recommendations I strongly propose for our industry is consolidation. We need to consolidate. In my view, we should have less than 20 insurance companies, large ones. In the 90s, Nigeria went through bank consolidation, but it was forced by the government. Okay? They just increased the minimum capital to 200 billion. And overnight, it reduced from 80 to 25. Now they are even below 50 through natural consolidation. I would propose the same thing for the insurance industry in Kenya. I don't know how many there should be, probably 10. My recommendation is probably something less than 20 anyway. And increase the capital, give them incentives to consolidate. There could be some tax rebates, say 5 years if you consolidate and create a mega insurance company of this size, you get some tax rebate. Okay? So that way, then people come together and consolidate the industry. The customer benefits because of economies of scale. The investors benefit because then they start enjoying returns. The costs in the industry will drop because the cost per unit then drops dramatically. So there are benefits across the board. So I advocate for light regulation. Okay? Increase competitiveness in the market, but make the players larger. So in that way, it creates that confidence in the market. People ask me, why did we go with Allianz? You are the largest insurer in East Africa. Allianz is the largest general insurer in the world. So why would two large players come? But it's all consolidation, economies of scale. So all these things need to continue. So if you are a small company, start thinking of how do we create scale, because scale benefits the economy eventually.
Dr. I must ask you this question as we wrap up. We have seen you in Kenya Wildlife. We have seen you at Equity Bank. We have seen you at Chumi. We're now seeing you at Jubilee. For those of us who analyze this market, some of us say, this guy is a jack of all trades, probably a master of none. How would you respond to that?
I'm not a jack of all trades. I am a master of a management skill. Okay. There's a course I used to teach at the University of Nairobi and some other places called the General Systems Theory. The General Systems Theory shows you what is common across all systems. It doesn't matter what it is. Okay, whether it's a church, whether it is government, whether it's a business like Jubilee, okay, they have the same common trend, exactly the same. And so therefore, if you master that, then you can manage any entity. So that is where the skill is. Yes. So it's irrespective of industry. I can tell you I can be a very good pop.
So yours is more of a diversified portfolio.
Yes. So it doesn't matter the portfolio, the principles are the same across the board. So the key thing is to master the principles. Once you understand those management principles as espoused in the General Systems Theory, and you master them deeply, you can run any system.
Final question. As a former head at Chumi, seeing where it is today, what would you recommend?
The company had a huge capital hole of around 5 billion. So the company, that capital I was proposing 60% equity and 40% debt. A combination of that would have brought the company out of the hole it was in. And so, if you look at the history of that company, it is traceable to the Africanization that Gikonyo Kiano designed in 1963 when he was Minister for Trade. And so there are several institutions. It probably takes a little longer to explain what it was originally. So institutions like Kenya Industrial Estates, ICDC, Uchumi itself, Kirdi, there was an institutional structure which was built to support Africa business. Unfortunately, a lot of those were lost in the late 70s, some parts of the 80s through the structural adjustment programs. World Bank didn't even understand what it was. So we lost it. But countries like Malaysia used the same infrastructure to create what they are today. So we lost the way. So Uchumi was one of those institutions for aggregation. What it wanted was, you see, the SMEs that ICDC was creating had no outlet. So we had to create a supermarket that allows those SMEs to display their goods at scale around the country. So that was the role, and that role has not changed even today. It has not changed. So when I explained to some key actors in government who probably never understood that, they couldn't then provide the capital that was required then to revive it, to play that role, okay? It had been privatized, but the privatization also created its own challenges. There were guys who came and did some new maths, okay? So the role of an aggregator at supermarket level still stands, okay? A private player like Nakumat came in, but it needed strong regulation. You know, market failure was high, so the regulator needed to go there. But we don't have a regulator for supermarkets. There are none. So my own recommendation is that we need a supermarket that allows SMEs to market their produce. And that was the role of Uchumi. And to me, it has not failed even up to today. That need still exists. Yes.